Welcome to the Deep Dive, where we dig into your sources for the key insights. Today, we're tackling something that's really shaking things up. The surprising way gold is moving in 2025. You probably think of gold as, emergency money, a safe place when things look rocky. But what our sources are showing this year is, well, it's really unexpected.
It really is. For decades, gold had its place, right? It was the insurance policy, the thing you held on to hoping you wouldn't actually need it. You'd see it move when there were geopolitical flare-ups or when the economy looked like it was heading for trouble.
Exactly, kind of the default crisis asset. And stocks, well, stocks were where you went for growth, for building wealth over long term,
Yeah.
investing in companies, innovation. That was the main game. Gold is more for when that future felt
hmm
shaky, almost a fallback.
And look, history pretty much backed that up. Over long stretches, diversified stocks definitely outperformed gold. That's why, financial advisors usually leaned heavily on equities.
But that's where 2025 throws a curveball, according to our sources. This year, gold isn't just keeping pace, it's actually growing faster than the stock market. And that's not a tiny blip, it's a pretty big shift from how things usually work, and it's challenging some really core investment ideas. So our mission here is to unpack what's fundamentally changed, what's driving this, and what it might mean for how you think about gold as, well, a real investment.
Yeah, it's a recalibration almost nobody saw coming. Gold's just defying the old rules on several fronts.
Okay, so let's get into this unusual behavior, because gold isn't just climbing fast. It's doing it even though the economic backdrop should be pushing it down. We're talking high interest rates, strong U.S. dollar.
Exactly. And this is really critical to understanding how much things have shifted. Gold doesn't pay interest, right? So usually, when interest rates go up, holding gold becomes less attractive. Why hold something that yields nothing when bonds are suddenly offering a decent return? There's an opportunity cost there. Investors usually chase yield.
Makes sense. And the strong dollar, how does that normally play in?
Well, gold is priced in dollars globally. So a stronger dollar makes it more expensive for buyers using euros or yen or whatever. That tends to dampen demand from outside the U.S.
Right.
So you've got these two big forces, high rates, pulling investors elsewhere, a strong dollar making gold pricier internationally, both of which should be headwinds. But gold is still climbing. It tells you there are other, more powerful things going on underneath, overriding those traditional factors. It really suggests a deeper rethink about gold's value.
Okay, so if the old rules aren't applying, what are these new powerful drivers? Our sources point to a few big ones, starting with something huge happening with national banks. Central banks are buying gold like crazy.
This might be the biggest piece, and maybe the least talked about. Since the pandemic, central banks globally have been hoarding gold. I mean, levels we haven't seen in decades. Hundreds of tons every year. And this isn't just like bargain hunting. It looks like a very deliberate strategic move. They're shifting some of their reserves away from things like U.S. Treasury bonds.
Wow. So these typically conservative institutions are actively moving away from assets that used to be considered rock solid. What's that telling us? Why now?
It signals a growing unease, basically. Central banks are diversifying for a mix of reasons. Geopolitical tensions are rising, so holding another country's debt feels riskier. They want to be less reliant on any single currency, especially the dollar. And maybe the biggest factor is just the sheer amount of government debt out there, particularly in the U.S. They're looking for tangible assets, things that aren't tied to one government's policies. Gold fits that bill. It's kind of a quiet vote of no confidence, or at least a major hedge against the long-term stability of fiat currencies.
And speaking of debt, that leads right into the next factor our sources flag, the massive U.S. national debt. It's at eye-watering levels. And that raises big questions about how it gets managed and what that could mean for the dollar itself.
Yeah, it's a fundamental economic problem. How do you handle that much debt? One way governments can deal with it is, well, essentially by creating more money. Quantitative easing, big spending programs without matching growth. When you flood the system with new dollars, you dilute the value of existing ones. That's what people mean by weaker dollars. Your money just doesn't buy as much.
Okay, so weaker dollars means inflation, basically. Stuff gets more expensive. How does gold fit into that picture?
Exactly. It hits your purchasing power. If your dollars are buying less, assets that tend to hold their value against inflation suddenly look much more appealing. And gold, because there's a limited supply, is seen as a stable store of value compared to a currency that could be, deliberately devalued through policy. It's a way people try to protect themselves from that loss of purchasing power that sort of hidden tax inflation represents.
So that fear of weaker dollars, fueled by the debt, does that connect to a broader shift? Are sources suggesting that the world's trust in the US dollar as the global currency is actually starting to fray a bit?
Looking at the bigger picture, yeah, absolutely. The dollar's been king for a long time. But all these things, the debt, potential money printing, even using the dollar for geopolitical leverage, they make other countries nervous. When people start worrying about the future value or even just the accessibility of the dollar, they naturally start looking for alternatives, holding reserves, trading goods. It's not like the dollar is going to collapse tomorrow, but you see this gradual erosion of its dominance. And that naturally boosts assets like gold, which exist outside any single nation's control. The search for trustworthy alternatives drives demand.
Okay, so we've got central banks making big moves, serious concerns about debt and the dollar's future. But maybe one of the biggest shifts in how people think about gold, especially big money investors, comes from BlackRock, the world's biggest investment firm. That's huge.
It absolutely is. When BlackRock changes how they classify gold, it's not just changing a label, it's a massive signal to the entire financial world. Think about institutional investors, pension funds, endowments. How an asset is categorized determines whether they can even hold it, how much they can hold. Gold was often stuck in this alternative bucket or just seen as a short-term hedge. By calling it a real investment, BlackRock is essentially giving the green light for these massive pools of capital which have strict rules to allocate more seriously to gold.
So it's like BlackRock saying, okay, this belongs in the main portfolio now, and then opens the floodgates for others who follow their lead. What exactly does real investment imply here?
It implies it deserves a place, alongside stocks and bonds for the long term, as part of a properly diversified strategy. It acknowledges gold's role not just as a temporary safe haven, but as a potential hedge against inflation, currency issues, geopolitical risk. It pushes back against that old idea of gold being just a useless, barbarous relic. It suggests maybe the traditional safe havens, like government bonds, now carry their own new risks. And you have to think BlackRock is doing this now specifically because of the environment we're in. They're offering clients a way to hedge against the very risks we've been talking about. It's a response to a changing world.
That was really interesting. So, okay, with all this momentum and this big institutional nod, if you're listening and thinking about maybe getting involved, our sources also outline the main ways people typically invest in gold. Each has its own pros and cons. The first one's the most direct, I guess.
Yeah, buying physical gold, actual coins, bars. There's definitely a psychological comfort for some people in holding a tangible asset, something you can actually touch that isn't just numbers on a screen. But like you said, there are practicalities. Where do you keep it safely? A safe deposit box, maybe a vault, that costs money. And selling it isn't always instant. It takes a bit more effort than clicking a button on a trading app.
Right, you can't just, stick a gold bar into the mattress and call it a day. So for people who want the exposure but not the storage hassle, there's a more modern route.
That's where gold ETFs come in exchange-traded funds. These trade just like stocks on the major exchanges, and they're designed to track the price of gold. Usually the ones people focus on are physically backed. That means the fund actually owns real gold stored in secure vaults somewhere, often run by big banks. So when you buy a share, you own a tiny piece of that physical gold. It gives you the price movement without needing your own vault. Much easier to buy and sell, generally lower transaction costs. You do pay a small annual fee, the expense ratio, though.
Okay, that sounds more accessible. And then there's a third way, right? Investing in the companies that actually dig the stuff up.
Right, investing in gold mining stocks. So here, you're not buying gold directly, but shares in companies that explore for gold, mine it, and process it. Your investment's tied to how well those companies do. Now, this can give you leverage. If the gold price goes up, a miner's profits can shoot up even faster. But it also comes with a whole different set of risks. Things totally unrelated to the gold price itself, like how well the mine is run, labor issues, political problems where they operate, environmental rules, whether they even find new gold. So it can be much more volatile. It's a different kind of bet on gold.
Got it. So we've looked at the what, the why, the how of gold's big moment right now.
Mm-hmm.
But, and this is really crucial, we need to remember the history here and be aware of the potential downsides. This isn't necessarily a guaranteed path upward.
Absolutely. This is where perspective is key. Gold's current run is exciting, but let's not forget the long-term picture. Historically, and people often forget this when things are hot, stocks have generally delivered much higher returns than gold over long periods. If you look back 50 years, something like the S&P 500 has way outperformed gold. Gold's traditional role has been more about preserving wealth during tough times, acting as that hedge against inflation or crisis, not necessarily being the engine for growth that stocks often are. Sometimes it's called a fear gauge more than a wealth builder.
And that sets up this really important warning from our sources. Gold doesn't just go up forever. We have a pretty clear example of how it can behave cyclically, sometimes with sharp downturns.
Exactly right. Just look back after the 2008 financial crisis. Panic hit, financial systems look fragile, and investors piled into gold. It hit record highs around 2011. But then what happened? It didn't keep going. Gold actually fell hard, nearly 40% from its peak. It went into a slump that lasted almost 10 years before it really recovered those levels. It's a stark reminder that even when fear is high, gold can reverse course dramatically. It goes through cycles. It's definitely not immune to big drops, which can really test your patience if you bought near the top.
Okay, so we've walked through this really fascinating shift. Gold, traditionally seen as just emergency cash, is now, in 2025, being seriously looked at as a potential real investment.
Hmm.
And it's not random. It's fueled by this powerful mix of factors. Unprecedented central bank buying, real worries about U.S. debt and weaker dollars, maybe fading global confidence in the dollar, and even huge players like BlackRock changing their tune.
So, the big question this leaves you with as a listener is this time different? Is gold finally making a permanent shift from just being a safety net you grab in a fire to being a core part of a long-term investment strategy for this new economic reality?
And this is the crucial counterpoint. Is this just another gold bubble like we've seen before, where excitement pushes the price up, maybe too far, too fast, only for it to eventually pull back hard and maybe stay down for years?
Yeah, and as the whole global economic picture keeps changing and old indicators maybe don't work like they used to, how do we need to adjust our basic ideas about value, about security? Where does an asset like gold fit into that evolving picture? It's definitely something to think about as you navigate your own financial decisions in what feels like a very uncertain world.
Thank you for joining us for this deep dive into gold's surprising comeback. We'll see you next time on The Deep Dive.